Welcome back to Squawk Box. The European Central Bank raising interest rates by a quarter point, bringing up its benchmark rate to 4.5.
The European Central Bank just raised all its main interest rate for the 10th time in a row, reaching levels that haven't been seen in a very long time. Why should you care if you are in the US, in Australia, in India, or anywhere in the world? That's a good question. The EU is where you can find 400 million consumers. Taken together, the EU is the third largest economy in the world. It's a very important trading partner for all the major economies in the world, and it's also where you can find a lot of global companies. The effects of this interest rate will be felt this year and next year, and it's going to be affecting everyone, regardless of where you're living. I'm going to look at a lot of sectors that are being affected by this raise. Then I'm going to focus on Germany, the fourth largest economy in the world, but also the first one in EU, then France, the seventh largest economy in the world, and the second in EU. Then finally, I will tell you how I'm going to change my investing approach based on these changes. This should be interesting. Let's get started. On September 14th, Christine Lagarde and her team announced an increase of all their main rates of 25 basis points, and that was the 10th time in a row that they were increasing them. We reached a level rarely seen before of 4% for the main rate. The markets themselves were not too puzzled, but we'll talk about that later. Let's look at all the sectors that are going to be adversely affected. First, we need to talk about inflation, because this is what the ECB is concentrating on. Of course, the inflation has weakened. It's been 10 times in a row that they've increased the rates. But it's only on paper, because this is core inflation. This doesn't include food and energy. And when we look at food, the actual prices increased by 10% in August again. And this is affecting everybody. Nobody can start buying food. Otherwise, you can't live. So this is putting a lot of pressures on consumer. And this is not about to get better. Of course, there's the war in Ukraine continuing, and the wheat from Ukraine and Russia is not available on the market. And a lot of countries are reducing the export of food for various reasons. We can think about India, we can think about Indonesia. All of that is contributing to increasing food prices all across the world, including in Europe. Fortunately, Europe has a lot of food, is growing a lot of food, producing a lot of food, but still, the prices are going up, and they are going up for another reason, and this is energy. Because you need energy to produce everything and transport everything. Fortunately, in a way, the prices of energy have been reducing from their peak of last year progressively. However, everything is not getting better, because basically the gas and the oil that used to come from Russia is not available anymore. So everybody is gonna start feeling the pinch again as Europe is going towards winter, especially as all the measures that have been put in place by governments are now going away. The prices are not controlled, they are not restricted. So this will put a lot of pressure on all the citizens of the EU countries, because they might need more money to warm themselves or fill up the tank in their car, reducing their disposable income to buy anything they need. Companies are going to be suffering as well, because there is slowing global demand, there is already high energy prices, and on top, their borrowing costs are increasing. Why do they need to borrow? They need to borrow to be able to develop new products, to open new markets, maybe to increase their production. All of this is going to be putting pressure on their margins, reducing them a lot when they are already facing difficult market conditions. And by doing so, we're reducing their economic output. They're gonna have less money available to pay for employees, and also less tax revenue for the countries. Speaking about the employees, the labor market in the EU is still very tight, which is a great thing for workers. It's pushing salaries up, and they are more mobile. But at the same time, it's putting additional pressures on companies that need to put more money in front to be able to hire the people they need, or to keep the people they already have. Again, reducing their margins. This is really tough. And in EU, contrary to the US or other more liberal countries, it's very, very difficult to fire employees. So they are okay for some times, but if demand continues going down and there's severe economic pressure on the companies, they might be pushed to reduce the staff and start firing people. The same employees are also facing pressure, the same pressure, food price, energy price, and that's affecting the money they have available. Fortunately, there were a lot of government measures that helped them a lot during COVID, but all the money they put aside and the high savings they had are continuing to diminish as we are getting closer to 2024. So that's a lot of pressure for them. That's less money available for them to be able to spend. And spending is very important in the EU because spending, domestic spending inside the EU represents more than 50% of the overall GDP. So if domestic consumption slows down, the whole of EU might be slowing down. On top, there's a lot of talks in the EU now about immigration, which is fantastic. Everybody needs immigration, but there's a lot of illegal immigration, which is in itself a tragedy. And people are starting to notice there might be some social movements. There might be some political movement around that. So there's a lot, as you can see, for workers, a lot of different factors that might lead to negative reactions or just to have less money to spend and affect the economy overall. Now, if we look at Germany, which is the fourth largest economy in the world, but the number one in EU, it's been hit really, really hard by COVID. As you can see here on screen, it actually contracted this year and it's going to grow very, very slightly next year with a lot of inflation, mainly due to energy price. Germany had fantastic run from 2010 to 2020 with economic growth, with a lot of reform. Everything was nice. However, progressively, it started getting out of nuclear power, shutting down its nuclear power plant and depending a lot on Russian gas and Russian oil. So obviously, as soon as the war started, they got cut off from all of this, bringing their energy price very, very high and impacting their traditional production powerhouse, which is around the Rhine, and that was heavily dependent, obviously, on energy. And it's been very tough for all those companies to keep running and to keep having decent enough margin to make profit and continue to be competitive on the global stage. And why is the global stage so important for Germany? Because it's an export powerhouse, especially for industrial goods as well as cars, obviously, as you may know. And with the slowing global demand, they are feeling the pinch globally and internally with everything I've talked about. So really, it's a tough situation for the German economy. And overall, Germany represents 29% of the GDP of the EU. So the fact that it's slowing down and next year it will be barely growing affects a lot the whole of the EU. Now, let's talk about France, my home country, but also, and more importantly, the second largest economy in the EU. It fared a bit better than Germany, mainly because there was a lot of support from the government for all the households, which was really good for French people, bad for the budget though. And also because there's a lot of nuclear power in France, so the effect of the war in Ukraine was less felt from an energy standpoint. And that's great because France represents 20% of the overall EU GDP. The slowing global demand is affecting France as well. It's a big exporter. The increase in food prices is also affecting France. And now that the energy prices have no more restrictions, the households are starting to pay more for their electricity as well as the companies are paying more. That being said, the next presidential election and general election in France are still 3.5 years away. So if anything starts to look really bad, the government has a lot of time to be able to intervene and make things better in the next 3 years. Construction and real estate in general will be feeling the pinch of this rate increase. If we're looking at the first half of this year, before even the rate increase, the number of new mortgages had gone down by 46% year over year. And at the same time, the price of houses has started going down by 5%. It's not much, but it should continue going down because less people can borrow money, meaning that there's less people willing to buy. So people who want to sell will have to decrease their prices or stay with what they have. And we should see the number of transactions going down which is really bad for first-time buyer, which is really bad for retiree who would like to have money to be able to retire, and bad for constructions because people are not going to build houses if nobody can buy them, although there is a housing shortage in France already. It doesn't look as bright as it sounds for France, except maybe if the French rugby team wins the upcoming World Cup. That's going to lift the mood, and we have the Paris Olympics also next year, so that might help a little bit, but I wouldn't get my hope too high because that's a lot of heavy lifting to be done when you have so many negative factors at the same time. From a financial market point of view, things are actually a little bit different, which is weird. The announcement from the ECB was seen as a hint that there will be no further hikes in the foreseeable future. The market was so happy. Actually, stock rallied up, the euro went down a little bit because of the potential difference in interest rate with the USD, and the bond yield went down as well. European companies will need to learn how to deal with high energy price, high wages, slowing international demand, and potentially slowing domestic demand. That's a very tough act to follow. How could they cope with all of that? They need to learn how to be more efficient, they need to be able to be more innovative, and they might be able to rely on domestic consumption to make up for the exports that might go down, because domestic consumption represents 52% of the GDP in Europe and it's still very strong. What it means is that those global companies that are based in Europe, including the mid-caps, might be able to sustain themselves until the economy slowly recovers and the global demand recovers as well. If you're investing in Europe to diversify your portfolio, or if you're based in Europe because this is your home turf, it still means that you have to look at quality industries, quality companies, look at broad-based index to be able to spread the risk. Look at mid-caps because they might be quicker to turn around and to adapt to new market conditions. I still think that the ETF that I had showed before and that you can see now on screen are actually good options to look at if you want to continue investing in Europe, part of your diversification, or as I said, if it's your home turf, and invest as usual for the long run because things might be bumpy in the next 12 to 18 months. The global economic slowdown coupled with high energy and high food prices, tragic clandestine immigration, upcoming general election in all of these EU countries, as well as the continuing war in Ukraine is bringing a lot of uncertainty for the EU. The markets seem unfazed, which is great for a lot of investment opportunities as long as it's for quality companies and the risk is well spread with broad-based index. I hope this very quick summary was helpful for you to get your head around about what are the impacts of this recent rate increase. If you're interested to deep dive a bit more on France, you have this video available. And if you want to learn a new way to manage your money, you have that video as well. If you like this video, learn something, please give it a like. Do not hesitate to subscribe for more videos to come. And if you have anything to share or any question, please leave a comment below. Thank you again, and until next time, goodbye.